everyone. Welcome to this week's webinar. Today we're going to be talking about ETFs versus mutual funds. So we talk a lot about the high level as far as what accounts you should be setting up, different retirement accounts that are available, and all the different options when it comes to where you're going to save your money. Now, this is taking it one step further. Now you've put your money into this investment account, you've put it into the retirement account, a brokerage account, 529 plan, whatever it might be. And that's just the wrapper on the outside of the taxes and how the account works. And then once that money's in the account, it's just sitting there in cash until we do something with it. So that's what we're going to talk about today. Is the main options you have to pick from is ETFs and mutual funds that you can go buy in your portfolio to actually invest in the market. Now, the way that most of these works is, as I mentioned, it's the wrapper on the outside of the account that controls the taxes of a 401k or a Roth IRA or a brokerage account. But inside the investment account, you can actually buy the same thing in every single one of those accounts I mentioned and have the same investment strategy. So it's really two separate pieces of investment management on account location and how you're investing your assets. So why did I want to talk about ETFs versus mutual funds today? As I mentioned, there's some of the main pieces that we look at buying in our client's portfolio, and there are two different ways of looking at investing in the market. So one of them is what we call more of a passive investment, which means we're just letting it sit there and grow. The other one is more of an active investment, which means that we have managers actively trying to make changes in the portfolio to better the outcome. So that's what we're looking at today. As far as the investment strategy as a whole, both of them hold a basket of either stocks or bonds in the portfolio. And that's something we're going to go through actually next week, is we're going to talk about the difference between a stock and a bond. But both of them have multiple stocks or multiple bonds invested, and that helps lower the risk in your portfolio where you're not buying one individual stock and hoping that company does well and there's a potential for bankruptcy with that company. This is going to be spreading out your risk across hundreds, if not thousands, of companies where you're really following the overall economy in the market and not how one stock individually is performing. So they have different structures as far as how fees work, and we'll talk about that as well. And of course, this has a big impact on your rate of return. So we want to talk about where one might fit versus the other and how that can benefit your overall rate of your return in your investment strategy. So before we talk about ETFs and mutual funds and how each of them work, I want to start with talking about the S&P 500 because this is what I use the most when I'm talking about different examples in investments. And the reason I use the S&P 500 is because it is the most familiar to people. It's something they talk about on the news. They talk about the NASDAQ, the Dow Jones, and the S&P 500. I like the S&P 500 because it's the easiest to understand of those ones. And what it is, the S&P 500 is just the 500 largest publicly traded companies in the United States. So they talk about that on the news because, number one, it's the companies that you're most familiar with, right? It's going to be Google, Meta, Microsoft, Apple. And so it's all these companies that you use and you know about. So that helps when you're talking about it on the news. But also it helps because the biggest companies are really the biggest pulse on what's going on in the markets and what's going on in the economy. So by investing in these 500 companies or reviewing how these 500 companies are doing, you're going to get a pretty good idea of what is happening with the economy today. So with that, diving into ETFs specifically, what an ETF is, this is going to be the passive option I mentioned when you're investing. And so what I mean by passive is you look at, for example, the S&P 500 that we just talked about, you look at just buying all 500 companies within the S&P 500. The cost is going to be relatively low for buying an ETF because there is no strategy besides buying all 500 companies, and you can use a software to make sure that you always own all 500. Now, if one company has a bad year and they go down to 501, then the ETF is automatically going to sell out of that one company and buy the company that now replaced it as part of that 500. So there are some moving pieces still going on within this ETF, but it's very simple. You just own all 500 in the S&P 500. So I mentioned things like the NASDAQ or the Dow Jones. So you can own a Dow Jones ETF, you can own a NASDAQ ETF, you can own an international investment ETF that buys all international stocks out there, right? There's a bunch of different ETFs to choose from, but the premise is the same. It's buying all of whatever that index is in the market. One of the big differences that we'll talk about as well today is how you buy an ETF versus a mutual fund. So the way an ETF works, it actually trades like a stock. So you can look up the ticker symbol, the 3 or 4 letters, and see how the performance is of the ETF. And it's actually going to be moving and changing live throughout the day while the market is open. Mutual funds don't behave that way. They act a little bit different. But as far as ETFs work, they work just like a stock where you can see the real-time price of the ETF and where it's at right this second in real time and be able to make your investment based off of that. Now, ETFs, they are considered like a more modern investment strategy, but they've been around a long time, since 1993, well over 30 years that they've been around. And there's really not any risk as far as putting your money into an ETF besides just your traditional investment risk. Now, the alternative is going to be the mutual fund strategy. So mutual funds, and let me go back to that S&P 500 example. Instead of just buying all 500 companies, we look at what if we paid a manager to review all 500 and say, okay, who are the good companies that are going to be growing and going to be around long term? And who are the companies in this 500 that are actually on their way out? Maybe they used to be number one. Now they're down to number 100, and it's just going to keep getting worse and worse from here. So what a mutual fund is, you're paying for mutual fund managers to pick and choose who's going to be the winners and who's going to be the losers. So maybe you can buy an S&P 500 mutual fund that instead of owning all 500 companies, it only owns 300 companies. And that manager's picking which of the 500 they like, and 300 they like, 200 they don't like. So the cost with a mutual fund is going to be a lot higher because you are paying for the mutual fund manager's salary and their research to make sure that they're making the best decisions possible. But ideally, they're filtering out the losers who are doing a bad job, and you should get that higher rate of return than you would with an ETF. So mutual funds have been around significantly longer. They've been around over 100 years. So again, I wouldn't worry about anything with your money being risky investing in a mutual fund outside of just the performance and the fluctuations you're going to see with an investment, but not anything about your money disappearing from being in a mutual fund or anything like that. So we talked about cost a little bit. ETFs being much lower cost for the passive strategy versus mutual funds being an active strategy have a much higher cost. So an ETF could range anywhere from 0.03%, so very low fees, up to around, I would say, 0.75%. There's some out there, of course, that are higher than that, but typically they're going to be much closer to 0.1 or less as far as your expense ratio, your percentage fee of the amount of money that they're investing for you. Mutual funds, the lowest I've seen is around 0.35%, and I have seen mutual funds that go all the way up to 3% expense ratio. So that's pretty high, right? That means if you're investing $100,000, they're taking $3,000 a year to pay for their fee. Or think about it this way, you need to earn 3% of rate of return just to break even. So the first 3% that you make every year is just going toward their fee. So those ones are pretty crazy, pretty high. Again, the idea is that you should be getting a higher rate of return. So you shouldn't necessarily think of what's the lowest fee and that's what I want. You should be thinking about what's the lowest fee relative to the rate of return that I'm going to get. I'd pay 5% yearly fee if I was going to get 10% extra rate of return on my investment. I would be happy with that. But if I'm going to be paying a 5% fee and I'm only going to get 3% higher rate of return, it's actually costing me 2%. It was a bad deal. So we need to keep that in mind is it's not just low expense, it's low expense relative to the return that you should get. One other thing to mention when you do your research on mutual funds, if you see something that's 0.35% and it's that low, it's probably that low because you had to pay a sales charge. So there's certain mutual funds out there, different fee structures where you could pay something like 5.75% upfront sales charge. So you add $100, they're going to take $5.75 right off the top of your investment. But the benefit is then you get this low 0.35% going forward after that. So just make sure you do your research on the sales charge associated with the mutual fund, because again, that's going to take quite a bit of the rate of return to have almost 6% taken right off the bat, even if you get to benefit from 0.35 going forward. So one thing to note is the tax efficiency of ETFs versus mutual funds. So I mentioned how ETFs are the prices changing throughout the day. So you're getting a real-time view of your value of your investment. Mutual funds do not behave that way. They actually only post a price once per day at the end of the trading session. Then you get the new price after the market closes. So basically, you don't know what's happening with your investment throughout the day. And then at the end of the day, you see your posted price. The reason being is think of it almost as them being like managers of your investments where they're making trades and doing things throughout the day and they can't real time keep track of the different changes that they're making in your portfolio. So it's easier for them to just make any changes they're going to make throughout the day and then just post the final balance at the end of the day of what the mutual fund is worth. And that's how they'll calculate what your investment in the mutual fund is worth. So that's the differences there. And because the way that operates, they actually pass through capital gains to the shareholders annually. Toward the end of the year, they'll look at the investments that they've done throughout the year and how long you've been a part of that investment strategy. And they'll say, okay, throughout the year, we maybe sold 500 stocks for a profit during this year period. So all the profit that you got from them selling those stocks, you need to now pay taxes on the gains that they earned you throughout that time period. So they'll push that through, the capital gains through to the shareholder, and you'll see that on your 1099 and have to pay those taxes in the upcoming tax season. So you do need to keep an eye on that and the potential increased tax bill from a mutual fund. And ETF doesn't work that way because you're seeing everything in real time, and the way that the investment trades happen in the portfolio, they don't actually affect you. You just have that set ETF price and that price that you bought in at, and then the fluctuation of that price. You're not being affected by any changes. For example, if a company I mentioned drops out of the S&P 500 and a new one comes in, that doesn't affect your portfolio where you had to buy one and sell another. So you're not going to experience nearly as much capital gains in an ETF. So that's where it could be a great fit in like a brokerage account where you're trying to keep taxes low because there are no tax benefits to get. So you may want to try and focus on ETFs in a brokerage account to keep your tax bill as low as possible. So where ETFs really excel that I've seen, I just mentioned the brokerage accounts or taxable accounts is another word for it, is a great place to invest in ETFs. They are lower cost. And typically what I've seen is from different research is from 80% of the time, ETFs do better than mutual funds when you factor in the fee. So 20% of the time, you'd be better off buying a mutual fund. 80% of the time, you'd be better off buying an ETF and keeping your costs low. So there are pros and cons to both, but historically, ETFs have done better. If you're starting with a small amount, an ETF could be a good option because you could just buy one share of that ETF, right? It's just one price that's fluctuating. Mutual funds have different rules, and they may have a minimum investment that you're not ready for yet. So you'll just have to do your research on what you want to buy and see if you have enough money for whatever their minimum investment is. Lastly is tax loss harvesting. So we've talked about this in the past, where you sell on purpose when stocks are at a loss or when your investment's at a loss to get that deduction on your taxes. If you buy a mutual fund, they're going to be doing all those trades in the portfolio throughout the year. So they're going to be causing taxes. So that doesn't really help when you're trying to lower your tax bill when there are losses in your account. So you just don't have as much control over what your tax bill is going to look like from year to year because of the trades that the mutual fund manager will be doing for you. So that's everything I wanted to go through today as far as ETFs versus mutual funds. If you do have any questions, of course, feel free to leave them in the comments on this video and I can get them answered. If you want to talk about your unique financial situation and look at what you have set up, we can also do a review of your current investment strategy. I take a look at people's accounts all the time, see how they're invested, and look at maybe what we would do differently or if there's any changes I think you should make. So I'd be happy to do that for free if you wanted to set that up. But other than that's everything for today. And I mentioned next week we're going to dive into stocks versus bonds. So talking a little bit more about that and the differences between those investment options as well. Other than that, I hope you all have a great rest of your week, and I'll see you all next time.